Today we are going to talk about group taxation. Imagine you are the manager of a corporation that exercises control over multiple subsidiaries through majority shareholdings. Thus, your corporation and its subsidiaries form a corporate group that operates as a single economic unit. Now you wonder how your corporate group is treated for corporate taxation purposes. In general, under the separate entity approach, each legal entity is taxed separately, regardless of whether it is a standalone entity or part of a corporate group. This implies that if a subsidiary incurs a loss, this loss cannot typically be offset against the profits of the parent entity or against the profits of other group entities. Profits can be distributed as intercompany dividends and may be taxed at multiple levels of the corporate group structure, as explained in a separate video. To overcome these disadvantages, in many countries, corporate groups can elect to be taxed under a group taxation regime. Usually, group taxation regimes are only applicable in a domestic setting. They allow domestic corporate groups operating as a single economic unit to be treated as one single entity for taxation purposes. Group taxation allows for a consolidation of profits and losses within the tax group. That is, if one entity within the group incurs a loss, it can be offset against the profits of other entities. This provides a liquidity advantage compared to the usual treatment of losses, which is explained in a separate video. Importantly, the consolidated profits and losses are only taxed at one level, the group's head unit level. The head unit of the group pays the tax to the tax authority for the whole group. In addition, group taxation may allow for a deferral of taxes on transfers of assets between group entities. That is, transfers of assets may only be taxed when a profit is realized, such as through a disposal of the asset to third parties. Compared to the separate entity approach, this provides another liquidity advantage. It is important to note that the exact characteristics of group taxation regimes are country-specific. Both the benefits of group taxation and the requirements for its application depend on the respective jurisdiction. To summarize, group entities are generally treated according to the separate entity approach unless a group taxation regime applies. Under group taxation, the entities of a group are treated as a single economic entity for taxation purposes. Consequently, only the head unit has to pay the taxes for the whole group. The tax base includes the profits and losses of all group members and is adjusted for intra-group transfers. This results in a liquidity advantage for the group.